Hey everyone, we've dialed in our third quarter 2024 commercial real estate performance metrics. So this week I'll focus on what the data is telling us about the apartment and office markets. Next week I'll hone in on the retail and industrial property types. So now let's start with apartments. In the third quarter, the national multifamily vacancy rate came down by 20 basis points to 5.6%. About where it was a year ago. Now, considering the record level of apartment completions over the last few years, a vacancy rate decline is actually a little surprising and very welcome news. We had almost 163,000 new units come online in the third quarter alone. That's a record. We have nearly 30 years of quarterly multifamily data, and 163,000 units is more than were built in most years during that span. So for the vacancy rate to actually go down with that many units entering lease up is really remarkable. Total apartment absorption for the quarter was just north of 191,000 units. And that's the strongest quarter we've seen since the second and third quarters of 2021, when we had the post-COVID bounce. And that strong upward trend in apartment absorption reflects a few things. First, the US still faces a housing shortage, and the wave of new units over the last few years has increased the inventory of apartments that can be absorbed. So as the number of available units increased, the housing demand was already there to fill them. But the decision someone makes to go out and rent an apartment, the decision to create a new household, is influenced by a variety of things. People's employment status, their income, their sentiment about their economic future. And last year, when the media was focused on inflation and the risk of a recession, I think a lot of people took a cautious posture and held back on forming a new household. But this year, as inflation has come back under control and employment has continued to chug along, adding new jobs every month, I think people's confidence in their personal financial outlook has strengthened enough to trigger household formation and housing demand. But when you look metro by metro, supply and demand didn't line up exactly. As I've mentioned in previous videos, the completions have been relatively concentrated across the Sun Belt in Texas and Florida, Atlanta, Nashville, Phoenix, Charlotte, and so on. And those markets did get the lion's share of the absorption. But there are a lot of metros where construction has been limited, but absorption picked up nicely over the last 12 months. Places like Washington, D.C., Las Vegas, Portland, Oregon, Sacramento, Detroit, and San Francisco. Those are some of the markets generating outsized vacancy compression. The question, of course, is whether the trend will hold. And as the Marcus and Millichap research team hammers out our outlook for the 2025 multifamily investment forecast books, which will come out in January, I can say that we anticipate multifamily housing demand will keep pace with construction in 2025, so the trend should hold, at least on a macro basis. Now, I'll talk a little bit about office. The story for that property type is a little different. You may be surprised to hear that office space demand was positive in the third quarter, with absorption just north of 26 million square feet. That was just enough to bring the office vacancy rate down by 20 basis points to 17%. 26 million feet is the strongest quarterly absorption we've seen since 2021, and it falls on the heels of about 10.6 million square feet of absorption in the second quarter. So we are seeing some office space demand momentum. And fortunately, space additions have been minimal. We're expecting about 50 million square feet for all of 2024, which is the slowest pace of construction since 2012, when we were coming out of the global financial crisis. But even though vacancy ticked lower in the third quarter, I don't think we can say the market has turned the corner yet. Vacancy rates are creeping lower pretty much across the spectrum. Class A, B, and C, suburban and CBD office, they're all moving the right direction, just not a lot. and I think the jury is still out on exactly what the use case for office will be in 2025 and beyond. We continue to see increased pressure to return to the office in the financial services sector, and we're beginning to see it in the tech sector. But I'm still waiting for that clear change of psyche in the marketplace that would lead to broader utilization of office space. In the meantime, I'm hearing that demand is bifurcated. There are well-performing offices that are nearly 100% full, and there are poorly performing buildings that are completely vacant. For investors, it's really a hit and miss scenario, and from what I'm hearing, office debt availability remains very tight. So for multifamily investors, the outlook appears to be improving. And the office outlook is also improving, but there's still a lot of questions to be answered. We still have a lot of variables in play. The election, interest rates, job creation, economic growth. And that's why investors need to keep their eyes on the horizon.